Hello and welcome to our new CRU Fertilizer short-term forecast summary for raw materials prices for June 2020. In this brief webcast, CRU's Head of Nitrogen Analysis, Laura Cross, is going to run us through expected ammonia prices over the next 6 months, before CRU's Head of Sulphur and Sulphuric Acid Analysis, Peter Harrison, summarises the 6-month price forecasts for those products. We're doing this during lockdown in London, so apologies if there are any loud car horns or alarms or trains or anything else like that. But let's get started on ammonia. So Laura, what are we expecting to happen on the prices side for ammonia?
Thanks, Tom. So there are a few main points to cover when it comes to our ammonia price forecast this month, and I'm going to take you through those, but you can of course read the more detailed summary in our published forecast. So firstly, prices in Southeast Asia and the Far East more generally remain incredibly weak on the back of the slowdown in industrial production in the region. And this was really the first part of the world where we saw the impact of COVID-19 lockdowns on industrial output, and the dramatic collapse in ammonia prices that we witnessed in the East was as a result of that. And now, as you may have seen from some of the other pieces of work that the team here at CRU has put out, the current Southeast Asian FOB prices are actually far below what we assess to be the cost floor of the Indonesian and Malaysian exporters. And we understand that this has been able to take place because of government support to producers, particularly in Indonesia, where we haven't had much of a cutback or a flexing of the ammonia capacity relative to other products. What has changed in the last few weeks, however, is that prices appear to have reached a floor in Southeast Asia, and that takes us to an average FOB price of $180 per tonne FOB. And even though that is not directly related to the cost position of producers, as I described, it does represent a level that producers are seemingly unwilling to go further below. And it's as a result of this floor being reached that we have amended the trajectory of our East of Suez price forecasts. So what we expect now is for prices to remain relatively flat over the course of Q3. And that's in response to the market really hesitating ahead of a recovery in downstream industrial operating rates. If we look, however, to the west of Suez markets, we have a different trajectory, as you can see from the chart on the left of this slide. We have, however, kept a similar outlook for the Black Sea, Baltic and Tampa benchmarks compared to our previous forecast. And the main drivers of this are the fact that the seasonal ag demand in the US is now coming to a close. And our view here on how these prices are likely to play out over the next 6 months is really crucially based on our assumptions on plant shutdowns and production cutbacks. Now, ammonia plants around the world are running at high rates at the moment, and outside of the announcement that we had from Nutrien a couple of weeks ago that it is temporarily shutting down one of its plants in Trinidad, we really have not seen any indications from global ammonia exporters that they are going to be cutting back or that they are thinking about it at the moment. And if we assume that this continues beyond the next couple of months, it's very difficult to see that there is anything to stop prices in the west of Suez markets failing to fall to this level and catch up with the trend that we saw in the east. And our forecast for the Tampa CFR price is that we'll bottom out in August at a level of around $195 per tonne CFR. And that's before we then start to see a response on the supply side and also in the run-up to the fall application season in the US. And as a result of these trends, the previous traditional premium that we tend to see taking place with the East markets being priced higher than the West, which as you can see on the chart on the right-hand side, this has dramatically collapsed, but we do forecast that to recover. And some of the key drivers for that are the fact that we expect industrial production to pick up in the East a little bit more quickly, but also as the West enters the quietest part of the year for seasonal demand. So that leads us to a recovery in the prices in the East over what we're seeing in the rest of the world. Our key risk is to the upside this month, and this reflects the possibility that several producers may actually voluntarily choose to cut back production before they reach their floor. And we have seen this happen in the past in the ammonia market. It can be quite unexpected, but it has the potential to negate some of the severity and price forecast decreases that we have that you can see on the chart here on the left.
Thank you, Laura. You touched on lower demand from industrial buyers in the Far East there. Have you been able to quantify that slowdown, and when might this come back to normal?
Yeah, so we've made our reforecasts of what we expect in some of the key import markets for 2020. And when I say the key import markets there, I'm referring to South Korea, China, and Taiwan. And we do expect that overall there will be a significant impact on total demand for 2020. And we do have that offset, however, with a recovery in industrial production rates starting from Q3. And that starts earlier in the East than it does in the West because of the stage of progression that COVID-19 is at. An interesting thing to consider, though, is that when you look at the latest import data for those countries, so we've got January to April for most of those now, it actually shows that the imports were not dramatically impacted in the first 4 months of the year. And what that reflects is the fact that the industrial production rates are now starting to be a little bit slower, but also that ammonia storage levels are pretty much full at many of these downstream producers. So what that means is that tempers some of the expected increase that we would have had in our forecast otherwise. So that keeps the Southeast Asian prices below the $230 per tonne FOB level.
Okay, thanks again, Laura. Moving on. Okay, Pete Harrison is going to run us through the sulfur forecast for the next 6 months. So what's expected to happen on the prices side, Pete?
I think the interesting thing on the sulfur market is that this decline in price and the kind of environment we're in now has been a long time coming, really. So if you look back to the last peak in prices, that was at the end of 2018, early 2019. And really the sulfur market's been on a pretty steep path of decline until late 2019, early 2020. And that path of decline obviously predates the COVID-19 situation, and it's really down to a path of oversupply, so slightly weakening demand, but again, particularly strengthening supply growth. So actually coming into the start of 2020, the sulfur market was weak, and again, that's dissimilar to a lot of other fertilizer commodities and commodities in general. So actually at the start of the year, the market recovered a little bit. Actually, January, February was the low point for sulfur market in 2020, and prices moved up to a peak in and around April time. And one of the big drivers of that was both tightening supply. So one of the effects that COVID-19 has had is obviously been restricting the movement of people, and that has had the effect of restricting and reducing demand for fuel, which has again triggered oil refiners to cut back utilization rates, and that's resulted in a reduction in sulfur supply. So if you think of the oil refining market as about 50% of all global sulfur production, and oil refining rates have fallen by somewhere between 15 to 25%, depending on the region of the world, there's a really significant correction in the supply side of sulfur. So that's been one factor. The other has been the return of demand. So China's been really key to that. Again, looking in January, February, March, obviously the typical weakening of demand in and around the Lunar New Year was taking place, but then obviously as well the COVID-19 lockdowns and restrictions of product movements further compounded that. So if you look at the first 4 months of 2020, Chinese import demand for sulfur is down around 25% year on year, and actually the lowest import level on record, actually, so lower than the dip that we saw in 2016 as well. So a very, very weak start to the year, but actually that spike in prices up to the point in April is really representative of import arrivals that will come into China in May and June, and again is kind of highlighting how much weaker supply availability has been. So a relatively modest jump in import demand has triggered quite a significant price correction. So again, prices reached a low of in the $40 per ton range, FOB Middle East, but then rebounded up close to 60 by the end of April. So looking from this point forward, our expectation is for prices to broadly move in a range of low to mid 50s up to around $60 per ton, and that's really driven by a number of factors. So one reason that it isn't falling back to the kind of levels of 40s is the tightness of supply, but a reason that it isn't taking off and going back up to previous historical highs is that demand is actually still fairly weak. Another factor is stockpiles, and particularly Chinese port stocks. So looking at China's port stocks, you can see that they peaked at 3.2 million tons in and around February 2020 and have since declined. One thing looking at that decline is the spread of that decline across different regions of China. So on the river, so on the Yangtze River, where it's typically indicative of demand coming from the Hubei phosphates industry, but also very commonly associated with trader and speculator activity, domestic trader and speculator activity. Port stocks have only fallen by about 0.3 million tons. And again, looking back to May 2019, when stocks really started to accelerate, it was the river stocks that really took the majority of that material in and held that material and has been holding that material since May 2019. But then in contrast, if you look in the south, port stocks there are down by close to 500,000 tons, and the vast majority of all of the decline in Chinese port stocks have come in the south, which again is much more representative of end users. So typically, again, supply going into the southern provinces of China that again are heavy producers on the phosphate side. So again, looking at the imbalance in stocks, you can also see an imbalance in demand as well. So the total stock position in China is still very high, still at record highs, only just down from that peak of 3.2, but the proportion is a lot less supply availability in southern China than there is on the river, and it's really those buyers in the south who have spurred this increase in activity and driven prices a little higher. So looking at the risk of this forecast, I would say the key risk is probably towards the upside, and really is based around the potential that demand continues to strengthen, but supply is slower to recover. I mentioned that the production side has seen very heavy cuts in production. So again, demand has been improving going forward in this year. Improvements in higher levels of pricing in some of those end-use markets, particularly the phosphate sector, is expected to improve the ability for consumers to pay for sulfur. But as I say, that very significant cut in production could be longer lived and longer lasting than we're expecting it to be.
Thanks, Pete. So based on that, what is the actual likelihood that sulfur supply does not recover in the second half?
So really the risk around that supply recovery is all around restrictions of movement and all around lockdowns around the world. So again, as I mentioned, the cut in refinery rates has been because people are not driving cars, they're not flying planes, and even actually they're not moving goods around the world. So again, bunker fuel demand significantly weaker than it had been. So we're already starting to see countries and regions come out of their lockdowns. So most notably and earliest would be China. And again, refining rates in China have recovered. Again, not back to the levels they were at in December 2019 and January 2020, but they're significantly up on where they were at a low point in March and April. Also, the US is starting to ease lockdown restrictions. Obviously, much of Europe also starting to ease their restrictions. And so we should expect to see refinery rates recover in line with end user consumption. However, obviously any reinstigation of those lockdowns and strengthening of restrictions again on a wider scale could well limit how far and how quickly refiners are willing to or able to bring back utilization rates.
Thanks, Pete. Okay, you're gonna stick around and give us the sulfuric acid explanation. So what's going to happen with the sulfuric acid prices in the next 6 months?
So again, the sulfuric acid market, although people think about sulfur and acid being very heavily related, is where it is for very different reasons, but is in a very similar place proportionally to the sulfur market. Again, oversupply pushed the acid market down very sharply and saw this big correction in prices, but much of that correction happened by the end of 2019. So with FOB prices in Europe in the 30s, CFR prices in Chile in the 60s and 70s, that was a long way down from where the market had been at the start of 2019. So again, a second correction and again a sharper correction into February and March was really driven by particularly supplier concerns around demand and around the potential for very rapid and very widespread demand destruction to take hold. Again, smelters are in a position where they simply need to move acid volumes to mean that they don't forego the potential to continue making copper and zinc and lead and nickel. So they're in a position where prices is in this situation a secondary concern. So again, looking at what has happened, European FOB prices, as shown here, reached a low point in and around April of around negative 15 FOB. But if you look at Asian prices, Japanese, South Korean, Chinese prices, again, particularly in Japan, those prices reached a low of negative 40. South Korean and Chinese prices were closer to around negative 20s, negative 30 FOB levels. And actually, for pretty much the first time ever, prices into India were delivered at a negative value, so negative CFR prices in India, which is obviously incredibly unusual for a commodity market. One thing to say, though, that those prices were really a reaction to a fear of oversupply, but they also served a purpose in stimulating demand. So a lot of consumers who may well have been more tentative about buying decisions were spurred into making commitments, into making buying decisions at those kind of price levels, which is exactly what producers intended the result to be. So that low point has actually quite rapidly recovered. So East Asian FOB prices are no longer in the negative 30s and 40s. They're closer to the negative 10, negative 20 FOB range. And Europe is actually heading back to somewhere close to zero FOB on average now, just below at the moment, but moving in that direction. And as I mentioned, one of the big drivers of that has been affordability and the fact that those prices have fallen to stimulate demand. The other has been that sulfur prices have not fallen as far. So again, as I mentioned, both sulfur and acid prices have fallen very steeply, but proportionally acid prices have fallen further. So again, the chart on the right hand side here is showing the comparison of the implied margin of producing acid from sulfur. So it's comparing the acid price to the value contained if it were sulfur. So effectively the third of the sulfur price, which is the kind of the raw material nutrient value contained within a ton of acid. And you can see that typically that margin, again, as is noted here, is somewhere in the $10 to $40 range on average, depending on the market that you're in. For India and China, that implied margin has fallen to below zero, so a situation where purchasing acid is cheaper than the cost of making it yourself if you were in that position. And then even for markets where that implied margin is typically much higher and at a much more stable level, such as the US and Brazil, that value is now also at pretty low levels and again approaching zero. And that's really because of that divergence in price direction and stability between sulfur and acid. So the effect that has had, again in India, imports have increased, and one of the big takers of the the availability coming out of East Asia were Indian buyers. But also, if you look at the US, US seaborne imports in the start of 2020 are approximately 50% of the level that was achieved for all of 2019 as a whole. So there's been a big step up in imports both into the West Coast from Asia, but also into the US Gulf and Tampa from Atlantic markets, and actually some as far away as Asian suppliers as well. So the drop in prices that suppliers instigated has been effective from that point. So actually, our forecast going forward is for a increasing trend in acid prices, again coming from admittedly very, very low levels, but really down to a fact that the market is now a lot more balanced, because one thing that sellers did was not only sell existing tonnage, but also sell into the future and sell forward to limit the risk of again, future oversupply. So one thing that has done is that it has obviously serviced future demand for some consumers, but with sulfur still being very tight on supply, in markets where there's a possibility to purchase acid as an alternative, demand has been strengthening in those areas. So that's been a big push to the tightening of the acid market and improving in price sentiment and price direction, and an increase in prices for sulfuric acid over recent weeks and since around a low point in April. So again, looking at the acid market, the key risk that to this forecast again is to the upside, and I would say really is down to again that issue on sulfur. So if sulfur shortages are longer lived and those buyers who almost need to buy acid as an alternative, if that continues longer than expected, then that could again continue to accelerate and rebound that acid price higher than we're currently forecasting it to be.
Thank you, Pete. And the question follows on from that risk, really, in such an amazingly low price environment. The big question is just what level of potential upside there is if sulfuric acid prices, if demand continues to outstrip supply.
So really, the thing with the acid market, if structural consumers, so buyers who don't have sulfur burning capacity, if they choose to buy, arguably the upside is unlimited. In reality, that has moved to levels of, again, looking at the chart on the right-hand side here, previous historical margins. You can see in 2019 that the acid was being sold at $90 above the value of the raw material contained within it. One thing I would say that is pretty unlikely to be the case now, again, considering where demand market prices are and where end user demand is in industrial markets, for example. It's unlikely you get that kind of runaway. But one thing that is reasonable and possible if that situation continues on the sulfur supply tightness and you get buyers making more discretionary decisions to buy imported acid, is for that margin to recover back to a typical level. So again, if you look at China and India, that implied margin again showed here is down at around -20. If that were to move back to 0 or 10, you have an additional $30 in that Indian price that could fairly easily happen and still keep sulfuric acid as affordable. That wouldn't be taking acid to being expensive and unaffordable. That would just be maintaining and restoring what is typical. Again, if you look in the US and Brazil, the typical level of margin in those markets is $30 to $40 on average, something like that. And again, that's another $30, $40 on top of today's price. So I would say that as a immediate reaction to the market would be pretty possible. But it's also possible that things go beyond that. And again, as I say, the acid market has an almost unlimited upside given the right scenario. But some recovery to $20 to $30 higher than current prices would be possible if that demand side story really strengthened.
Okay, thank you, Pete. It's very helpful. And this was all part of our STF package, which is published on the first Tuesdays and Wednesdays of every month across the products. FW subscribers can find the entire forecasts across the nutrients on the forecasts or download sections of the website, while Market Outlook subscribers will find them on the relevant analysis section of the website. There you'll also be able to find our STF website for the downstream products. So please have a look at that if you're interested. For any questions or feedback, please get in touch with the team. We are always happy to help. A big thank you to Laura and Pete, and thank you for listening.